Assalamualaikum. I am Jawad Ahmed. Today we are present in the second chapter of economics, where our first topic is demand and its determinant. So before we can start our first topic of chapter number 2, kindly subscribe my channel so you can then get all my videos on a timely basis. Let's start. What is demand? Demand is the quantity of a good or service which buyers are willing and able to purchase at different price level. So demand is the quantity of a good or services which the buyers are willing and able to purchase at different price level. So in order to make a demand for a good, two criteria must need to be fulfilled. First is there must be willingness of consumer to buy the good or service. Along with this willingness, there must be ableness to buy a good or service. If both two conditions are fulfilled, that there is willingness to purchase something and the consumer is able to purchase the good, then such willingness and ableness both are called demand. For example, if you want to buy a car, there is your desire to purchase the car as well as you are able, you have sufficient money in your bank account or in your pocket so you can buy the car. Then such willingness, such desire or willingness or ableness to purchase this car is called demand for the car. So it's demand. So demand is the quantity of goods or services which the buyers are willing and able to buy at different price level. This is the definition of demand. Demand by a single individual is called individual demand. For example, demand by Jawad is a individual demand. Demand by Ali, demand by Feroz, demand by George, and all other single person demand is called individual demand. Whereas the sum of the demands of all the individuals for a particular good or service is called market demand. So it is the difference between market demand and individual demand. What is the difference? And make it right here. Firstly is market demand, demand of all consumers for a particular good or service. This is market demand. Secondly, individual demand. Individual demand is the specific person or a single person desire and ableness to purchase a good or service. This is called individual demand because it relates to a single person or individual person. So it is the difference between market demand and individual demand. Now let's move to the determinants of demand. What is this determinants? Let's move determinants. Determinants are the factors or reasons that are responsible for any change in a commodity or a service. So all such factors that can and that have the power to make any change in the demand of any commodity or service are called determinants of demand. For example, weather. So demand for ice cream changes with a change in weather. So weather is a determinant. Let's start. Read a complete list of determinants or factors that are responsible for making any change in the demand. So first is price of the product. If price of the product increases, its demand decreases mainly. But in case of inferior goods, when price of a commodity increases, its quantity demanded also increases. So it depends upon the type of the good, whether it is a normal good or inferior good. In majority, the goods are normal goods and some of the goods are inferior goods. Let them read from the notes. Price is a primary determinant. Primary means main determinant of demand. If price of a product decreases, if price decreases, its quantity demanded increases and vice versa. So price is a factor that can bring a change in the quantity demanded of a good. Let's firstly discuss what is the difference between demand and quantity demanded. Demand and quantity demanded. It's a fundamental concept of economics. If if any change is happened in the demand of a good due to change in price. So main thing is price. If any changes taken place due to the change in the price of the product, then it is called quantity demanded. If similarly, if any change is happened in demand due to other factors than price. For example, weather, temperature, and other factors, but other than price, then such change in demand is called only demand, not quantity demanded. So, hope the concept has been well explained. So, here the change has been done due to change in the price of the product. Therefore, it is the change in quantity demanded. Next factor is average income of consumer. Income has a direct relationship with the demand. If the income of the consumer increases, demand for the goods also increases due to the increased purchasing power of the consumer. So, if income of the consumer increases, demand for normal goods increases. For example, demand for automobile increases when the economy is in a boom. Boom means at the highest development stage, where all the economy has reached to certain level beyond which no development can be made. It is the highest level of development which an economy can reach, or highest level of success that an economy can reach during its tenure, but decrease when economy is in recession. Recession means price level decreases. So income has a direct relationship with demand. If income increase, if income of a consumer increases, its demand increases due to the increased purchasing power of the consumer. Difference between income and a wealth. What is mainly a difference between an income and a wealth? Income is the money that is earned by a factor of production at any given point of time. If you want to learn what is a factor of production, I've already explained it in our previous class. Although I'm explaining it here again for your kind reference, factor of the production or raw material or the basic requisites from which all other goods are made. These are the inputs. So the income from the input is called income at a given point of time. For example, rent, wages, whereas wealth is the accumulated. Accumulated means total income that have been saved and stored. It is the difference between the total assets and total liabilities. So the difference between total assets and total liability is called wealth. Wealth is equal to total assets minus total liabilities of a business. So the income that has been stored and saved for a future purpose called wealth, but the income that is obtained from serving or from utilizing a factor of production is called income. It is the second. So two factors of production have been studied. First is price and second is income of consumer. Now move to the third one. Third one is price of related goods. There are two types of related goods. Substitute goods that can be used in place of each other. And second is complementary goods. The goods that are necessarily to be used along with another good. For example, mobile and charger, bike and fuel, and other examples. Let them study. If price of complementary good decreases, if price for mobile decreases, demand for mobile increases, and the demand for the charger also increases. Demand for product also increases. For example, if price of a car decreases, then demand for petrol increases. Let them study here with the simple example of mobile and a charger. Both are complementary goods. So, if price for mobile phone increases, demand for mobile decreases and demand for charger also decreases because charger is normally used with the use of mobile. When mobile demand is decreased, charger demand is also decreases. If price of substitute good increases, price of Pepsi increases, then demand for Pepsi decreases and demand for Coke increases. So demand for product increases. That is price of petrol increases and demand for CNG increases because people have to move to something that is at a substitute end. Let them study with an example. For example, Coke and Pepsi. Both are substitute goods. So, if price of Coke increases, demand for Coke decreases. But the consumer have to satisfy their demand. So they will move to the relative cheaper good, that is Pepsi. So demand for Pepsi will increase. So it is the change in price of related good. Fourth one is size of the market. How much capacity a market have to bear. If number of buyers in a market increases, demand for the product will also increases. Demand of cars in Karachi or Lahore is much higher as compared to Larkana and Gujarat. For example, the consumer is belong to production of cars. Demand if demand for cars in Lahore is more than demand for cars in Karachi, then the producer will focus on such market where there is more chances of increasing the revenue for its business. So demand for Lahore market will increase. So market capacity or market demands matters a lot. The consumer or the market where demand for a specific good is increases, therefore the consumer or the buyers will also focus on such market where there is more availability of goods and services for the consumer, and producer will move to such market where there is higher demand and lesser availability of the good because both have their own objectives. Fifth determinant is expectation about price in the future. If there is unsure or people are not expecting price of the any market, then there is a higher fluctuation in the market. If increase in price of a product is expected in the market, demand for the product will increase because the consumer will try to save as much as money they can save. So So people will move towards such markets where there is high availability of goods. When there is a chance that the prices will go, higher and higher. People will buy more and more in order to save them from high prices. Sixth is expectation about shortage in the market. If there is a shortage expected in the market, then current demand for the product will increase because people want to store the goods in order to save them from the unavailability of the goods at a future date. So, expectation regarding shortage in the future also affect demand of a good. Seventh one is taste of or preference. Our taste or preferences change due to the change in culture, fashion, weather, special occasions. This will change demand for a product. For example, eating beef is common in Pakistan, but a tobacco in India. So every market has its own preferences and its own demands. So taste or preferences of the consumer matters a lot while you are deciding the demand for a product. Eighth one is advertisement. If there is more advertisement in a market for a product, then its demand also increases because the thing that is seen more is normally purchased more. It's a marketing term. In order to sell more and more your product, you have to make it more and more be seen or make available for the make available for the consumer at more ends. A successful advertisement will increase demand of the product and vice versa. Next and the last one, which is the ninth one, is availability of credit facility. Credit facility means loan facility. If banks are in a position to offer more and more loans, then purchasing purchasing power of consumer increases and he will demand more product. Similarly, if more and more loans are available for suppliers, then we will produce more and more. So, availability of credit facility increase demand for the product. Reason for decrease in demand will be opposite to those described above. Means I have already saying in previous sessions a word of vice versa. Vice versa means the next effect. I am describing the increase in price. Then decrease in price will be inferred by you. Reason for decrease in demand will be opposite to those described above. But in exams, you have to discuss movements in any one direction. Means it's up to you whether you explain increase in price or decrease in price. Only one factor need to be explained, other will be automatically answered. For example, how determine causes increase in demand. So it is our first class of chapter number 2, in which we have studied demand and its determinant, individual demand, market demands, and others a lot. If you have liked this class or if you have seek some knowledge from this class, kindly subscribe my channel so I can continue my services and continue to upload such videos that can help you in more and more way. Let's meet in the next class with the next topic.